Welcome to Business Administration and Finance. We're going to look at our managing expenses, credit and cash flows. This is Wordcast University. I will look at the following programs. Managing expenses, credit and cash flow. Objectives. Learn about managing expenses. Explore the role of credit in business. Investigate cash flow forecasting. Examine ways to improve cash flows. Managing expenses. A business can have many types of expenses, including payments for material equipment, merchandise for resale, which is inventory, rent, insurance, employee salaries and wages, sales commissions, and shipping and delivery. Managing expenses is a two-step process that involves the following: knowledge, which is a manager must be knowledgeable about the expenses the business incurs. Expenses are listed on the income statement, which is typically prepared on a monthly basis. Action. Once a manager knows the extent of existing expenses, he or she can act to reduce future expenses. Cost cutting measures include buying used equipment instead of new equipment, leasing buildings or camping vehicles as opposed to buying them, reducing energy usage, which is electricity, gas, and oil, and hiring part-time or temporary workers instead of full-time permanent employees. Let's look at the role of credit. Credit is the granting of extended time to pay off a debt. To buy on credit means buying now, paying later. A person or business that grants credit is called a creditor. Creditors set particular conditions, called credit terms. When they grant credit, these terms typically state the time limit when the debt must be paid and any finance interest charges that will apply. Although there are many types of credit, two types are particularly interested to business owners. So let's look at the trade credit. When one business gives another business an extended payment time for purchased goods or services, it is called a trade credit. Business owners take advantage of trade credit to postpone a payment of their expenses. Trade credit is used too for managing cash flow. Consider a retail store that buys merchandise by using the trade credit from a wholesaler who allows 30 days for payment. The retail store sells enough of the merchandise within 30 days period to pay the debt on time. In other words, the cash inflow is sufficient to pay the debt. Suppose the store has poor sales and does not earn enough cash in 30 days to pay the money back. This situation is known informally as a credit squeeze. The store will have to dip into cash reserves to pay the debt. Consumer credit. When a business gives consumers an extended payment time for purchased goods or services, it is referred to as consumer credit business. Consumer credit. Businesses choose to offer consumer credit to the public to generate sales. For example, a furniture store might allow consumers up to 12 months to pay for a purchase. Although credit cards are a form of consumer credit, they are issued by banks. A business that wants to accept credit cards from the customer must set up a merchant account with a bank. That bank works with the bank that issued the credit card to process the transaction. Merchants pay fees for these services and typically receive cash payments from the bank within a few days. Let's look at granting credit and collecting payments. A sale made on credit is based on trust that the person or business will pay the debt in the future. Every person or business that has ever used credit has a credit history, which is a record of credit transactions and includes information about whether or not they were repaid in accordance with the credit terms set by the creditor. Granting credit and collecting payments. A credit bureau is a business that collects and maintains credit history records and sells the information under the certain circumstances. Businesses can access credit records to help them determine if a credit applicant is likely to repay or a future date. Many businesses follow specific procedures when deciding whether or not to grant credit to an applicant. The first step is to collect personal information and financial from the applicant. For example, employment and income histories. Next, the business can check the credit history of the applicant through a credit bureau. If credit is granted, the Federal Truth in Lending Act requires creditors to inform customers about the credit terms, including any finance charges. Once credit has been extended to a customer, the creditor takes specific action to make sure the debt is paid. The creditor starts by sending a routine bill to the customer when the debt is due. Unfortunately, some businesses and individuals who are granted credit will not pay as agreed. The creditor usually makes several attempts to contact the customer by letter or phone to remedy the problem. If these measures are not successful, the creditor may hire a business that specializes in collecting so-called uncollectible accounts. Debt collection businesses charge a fee, often a percentage of the amount collected, for providing this service. Thank you. Now you can go ahead and write the test for this very course.